All right, cool. Share the screen. This is a company analysis session, right? So right here, what we're going to be doing today is making sure that uh not making sure we're looking for a competitive advantage in any particular company that we choose, but we do this every week. This is on Saturdays. Consider it like a study session to make sure that your investing skills don't waver. You gotta stay sharp with them. So you like anything else, like any other skill. But today we're doing Boyd Gaming Corporation, BYD. So we're doing Boyd Gaming. So got your book, pen. We're gonna start. Right. So obviously when it comes to investing, we're looking for winners. So there's certain metrics that you have to look for when looking at a company's financials. So obviously, if you have the financial science PDF, which is free, um, all you have to do is just look through every section, the income statement, balance sheet, and cash flow, and it'll break down for you what you're looking for, why you're looking for it, and examples of companies that have those metrics, which you can obviously tell have a competitive advantage. An example of one would be Coca-Cola. Coca-Cola has a competitive advantage over the other beverage companies around the world, right? So with Boyd Gaming Corporation, let's first go through what it is. So let's read the about. So Boyd Gaming Corp is a jurisdictional gaming company which engages in the management and operation of gaming and entertainment properties. It operates through the following segments: Las Vegas locals, downtown Las Vegas, Midwest and South, and online. The Las Vegas local segment consists of 8 casinos that primarily serve the resident population in the Las Vegas metropolitan area. The downtown Las Vegas segment refers to the following casinos: California Hotel and Casino, Fremont Hotel and Casino, and Main Street Station Hotel and Casino. The Midwest and South segment includes 4 land-based casinos, 6 dockside riverboat casinos, 3 racinos, and 4 barge-based casinos that operate in 9 states in the Midwest and southern United States. The online segment includes the operating results of online gaming operations. The company was founded by William Samuel Boyd and Sam Boyd on January 1st, 1975, and is headquartered in Las Vegas, Nevada. Cool. So to summarize it, Boyd Gaming is a casino conglomerate. They own hotels, which have casinos, and I don't think you need me to tell you exactly what a casino is. I'm sure that you know. And if you don't know, ask ChatGPT. I don't know no reason why you wouldn't know. Anyways, we're on the financials, right? So when it comes to investing, like I said before, what you're looking for is certain metrics that align with a company that would have a competitive advantage. Therefore, we have to look at everything. And I like to look at things on an annual basis because obviously year on year you want to see improvements, because the idea of holding an investment is to hold it from anywhere 3 to 5 years, right? So you want to see incremental increase in profitability, right? You don't want to see a company over the years lose money. You want to see a company over the years make money. So right here, revenue is tight. Net income in 2020 was garbage for good reason. Uh, Recovered in 2021. did better in 22. It dipped a little bit in net margins, but net income, total revenue increased a little bit, but net income and net margins went down a little bit in 2023. 2024, everything increased except for net margins. So net income and revenue both did good. All right. So they've acquired more debt, but this is the thing, right? Because this company owns hotels and they own establishments, like actual retail square feet, they have liability. Those properties that they own, they go up in value, obviously, but it's considered debt. When you buy a house, yes, your net worth is the value of the house, but it's still considered debt because it's a loan that you're paying off over the course of 30 years. So although you may see that they have $3.93 billion in debt, it's because that $3.93 billion is including the properties they own, right? But free cash flow over the years increasing. They were hot in 2021 and then 2022, and then it slowed down in 2023, and then it started coming back up in 2024. I would imagine that after COVID, everybody started rushing to casinos. So that enormous pop in free cash flow from 114 million to almost $1,810,000,000. That jump from 100 to 800, I would imagine, is because people came out of COVID, rushed into casinos, everybody's outside, and then the trend kept up for most of 2022, and then it fell off in 2023 because now everybody's back to used to being outside and whatnot again. But it increased in 2024. If we go quarterly, towards the beginning. So this year hasn't been too hot. Right? Cash and cash equivalents have been growing, right? But free cash flow waning. And then the debt ever increasing, right? So they haven't missed an earnings in the last couple quarters. Their next earnings is October 23rd. They haven't missed an earnings report ever. So 2021, 22, 23, 24, all knocked it out the park, right? When I say earnings report, what I'm referring to is a company's report card, basically. So they got straight A's, right? They didn't fail. So we look at the news a little bit. Not really interested, and then these are ideas, but nobody cares. So in terms of technicals, they got it as a buy right now. And now analyst rating, people who are doing what I'm about to do right now are saying it's a buy. We shall see. And it's performing better than 2024 and 2023 in terms of price action. So it's looking like it might be a good one. It's $86.48 as of the recording of this video, as of this live, per share, $86 per share. We're gonna go to the financials now. So let's dig in. So we're gonna put here BYD company analysis. So CA. Market cap 6.9, almost 7 billion. That's tough. They have a dividend yield of 0.83. So they pay a dividend. Their price to earnings ratio, very low. Is 13.4. We got around 16,000 employees. The current CEO is Keith E. Smith. We're gonna do some research on him real soon, but we already read the about. So ownership, Closely held shares, about 28% of it is closely held, meaning that it's the owners. Free float shares, which is for the public, it's about 71%. They pay about $2 million in interest. They got around 3.6 million in cash and cash equivalents. And the enterprise value is 10.87 billion. That's pretty tough. They got $4.26 billion in debt. They're working right now. They're working. Let's see here. So only in the United States. It's a US-based company, so you don't got to worry about tariffs and whatnot. So this is a breakdown of where the money's coming from. So you got Midwest and South in blue. Green, you have Las Vegas. Online is a decent chunk, about 15%. Downtown Las Vegas, that's a little teal, about 5%. So Midwest and South, 52%. LA, 22%. Online is 15%. Downtown Las Vegas is about 6%. And then managed and other, about 3%. So it's pretty solid. We got revenue, never missed. Earnings, never missed. Pretty good so far. I'm not going to lie to you. They started paying dividends in what year? 2022. So I had a dividend yield of 1.10%, and they're just slowly decreasing. That's interesting. Why? Why is that the case? Right? So they got more assets than liability. Let's see, annually. Just about 100 million more than, almost 100 million more than assets right there. All right, let's do the work right now. So we're gonna go here. So right now, this is TradingView, by the way. Let me start off by saying this. You can do this all on TradingView. You don't need extra gimmicks, extra sites. You can use them by all means. It helps, but you can do all of this on TradingView completely free. You don't have to pay for any of this. It's either that or you go to the actual SEC filing of this company's financials. So you can go, it's called EDGAR, it's an abbreviation, EDGAR, EDGAR. It's an abbreviation, but it's the SEC, the Securities Exchange Commission. They're basically like the stock market police. They regulate the entire market and all the companies that are publicly traded. And that's where all these companies file their annual reports, quarterly reports, their 10Ks and 10Qs, right? You can go to the site itself and you can read the entire, I'm gonna show you how, but point is you can do this all on TradingView. They make it super easy. You just have to go here to financials, and then you go to BYD fundamentals. You're gonna go to statements, and then boom, right here it is, bread and butter. So we're gonna unmark all of these except for total revenue and gross profit. Net income, we're gonna take that off. So you have your income statement, balance sheet, and cash flow statement. So we're gonna start. We're gonna start with the income statement. All right, so in the financial science PDF, like I said before, you have this right here. This is free. And we're going to start off. I made this, all of this, I made it. All right. So obviously with the help of multiple books, I just wanted to get like a complete understanding, because what people get wrapped up in is price, right? Like, oh, what price should I buy this company at? It doesn't matter what price you buy the company at, as long as it's a company that performs well and makes money, right? Because if the company performs well and makes money and you own it $86 and it goes down to $80, great. Now you can buy it at $80. It's cheaper now. Don't get wrapped up in price. Price doesn't matter, right? The price for what you pay for something is irrelevant. What matters is if the company is producing. Because in the short term, the stock market is a voting machine, and in the long term, it's a weighing machine, right? So you have to understand that if the company is performing very well, it just takes a couple quarters for the market to adjust its price according to the performance that it's been showing, right? So you just need to get in. And then when the market presents an opportunity for you to buy it at a cheaper price, you buy it at that price. And then you can either dollar cost average into it. You can buy a lump sum at that price. It doesn't matter, right? But you own it. And then you get a cheaper price later if it were to happen. Because if the company is performing well and it has a competitive advantage, the likelihood of it costing less in the future is very low. So you can either buy it now, $86, or you can wait till a year from now and buy it at $100, right? And then when you're like at $100, you're like, oh, but it could drop down to 86. Why didn't you just buy it at 86? Why didn't you just buy it at 86? It doesn't make sense. But I digress. Here we go. Income statement. The first thing that we want to look at is the net income divided by total revenues. Why? Because earnings percentage on total revenues is important. How much does a company keep from the total amount that it brings in, right? Companies with a durable competitive advantage will report a higher percentage. Obviously, if they have a competitive advantage, that means that they're capable of keeping more of the money that they make because they don't have competitors to which that they have to deal with, right? A company in a field where they're not where they don't have a competitive advantage and it's completely fierce and super competitive, you have so many costs just to keep up with the rest of the people that the rest of your competitors. But if you have a competitive advantage, all you have to do is give the product or service to the customers and they will buy in lump sums. And you will keep a lot of the money uh, for the company, in turn giving you a higher uh, percentage of net earnings to total revenues, right? So because of share repurchase programs, it is possible that a company's historical net earnings trend may be different from its historical per share earnings trend. Share repurchase programs will increase per share earnings by decreasing the number of shares outstanding. Because if you decrease the number of shares outstanding, right? When I say shares outstanding, what I mean is the amount of shares that the public have to buy, because there's only a certain quantity of shares that a company has listed. A company only has a certain amount of shares listed for the public to buy. If the public buys a lot of those outstanding shares, then the share price will then go up. The less shares you have, the larger the stock price. I hope that makes sense. So in terms of net income divided by total revenues, a company showing a consistent net earnings history of more than 20% on total revenues is there is a really good chance that it is benefiting from some kind of long-term competitive advantage. And a company with a consistent showing of net earnings under 10% on total revenue, uh, more likely than not, are in a highly competitive business in which no one company holds a durable competitive advantage, right? So we're going to do net income divided by total revenue. So net income divided by total revenue. We're going to do this on an annual basis because actually, no, quarterly basis. We want to know what it is right as of this second, because then we could do it again for the next quarter and see if they're improving or, you know what I'm saying? Or you could do quarterly and annually to see if it's growing or if it's weakening. Up to you. I'm just going to do quarterly, but I would recommend that you do the annual and the quarterly. So the 10K and the 10Q. That being said, where's my calculator? We're gonna do it right here. It's very simple. Bam. There you go. I was gonna do it on my phone, but rather. Right. So right. So total. Where is it? Here it is. So net income. Oh, that's gross profit. Boom. Damn. Hold up. Hold up. Hold up. Hold up. I got you right now. Here it is. Now we talking. All right. So net income is 151 billion. There you go. Million. Excuse me. 151 million divided by 1 billion. 14%. Not bad. Not bad. Next one up. Just look right here. Sorry. It's gross profit divided by total revenue. Right. So you have your net income and then you have your gross profit. So basically, net income is what you have after your expenses are paid. Gross profit is what you have for the owner, for you. Like, that's it. This is my money. Gross profit is, this is all mine. Right. Excuse me. I'm gonna run later, and oh my god, I already feel the food coming up, and I'm just talking. I know for a fact when I do those 6 miles, I'm going to die. Looking forward to it. Anyways, you have your cost of goods sold. Not that important because put it right here, although the cost of goods as a low number doesn't tell us much about whether the company has a durable competitive advantage or not, it is essential in determining the gross profit of the business. So we don't have to actually look at the cost of goods sold because the cost of goods sold is incorporated in the formula that we derive the gross profit from. So we just need the gross profit divided by total revenues. And companies with consistently higher margins of 40% or better tend to have some sort of durable competitive advantage. That being said, companies with margins of 20% and below is a good indicator of a fiercely competitive industry. Companies in fiercely competitive industries will never make us rich in the long term. Right? Right. So let's do some math. Gross profit, here you are. Net income, goodbye. Right? So let's do, excuse me, 457 million in gross profit. That sounds promising. Not gonna lie. That sounds very, very promising. Let's do some math. 457. Yes. Divided by, there you go. 44%. Okay. Gross profit divided by total revenue. 44%. Pretty good. Let me just give you a check. Write that out. There you go. So right now, for the income statement, we got 14% for the net income divided by total revenue. We wanted 20%, but as long as it's above 10%, it's okay. Right? Not everybody's perfect. So I like that it has a 44% gross profit to total revenue. Again, we had it right here. Companies with consistently higher margins of 40% or better tend to have some sort of durable competitive advantage. So as of right now, it seems like there is some sort of durable competitive advantage, leading them to have 44% in gross profit to total revenue. So selling, general, and administration expenses divided by gross profit. It's the percentage of gross profit used. In the world of business, anything under 30% is considered fantastic, right? So a company repeatedly, I'm gonna read the next one under that. There are a number of companies with a durable competitive advantage that have SG&A expenses in the 30% to 80% range. That's the caveat, right? But a company repetitively showing close to or in excess of 100%, you're probably dealing with a company in a highly competitive industry where no one entity has a sustainable competitive advantage. Steer clear. All right. So steer clear of anything above 80%. Anything above 80% is saying that they use almost all of their money to keep the business operating. We can't have that. We want ideally as close to or under 30%. Right? So this is Warren Buffett's research and development rule. Companies that have to spend heavily on research and development have an inherent flaw in their competitive advantage that will always put their long-term economics at risk, which means they are not a sure thing. And if it is not a sure thing, I am not interested. Right? If you have to spend so much on R&D to stay ahead of the curve, then there is an inherent flaw in your competitive advantage. Why is that? Why am I saying that? It's like for technology companies, for example, they have to consistently innovate, consistently make up the new thing, the new technology, the new hardware, the new this, the new that. They consistently have to do that. Whereas Coca-Cola just makes the same fucking drink. And everyone loves it. They haven't changed a damn thing for I don't even know how long, for 2 of my lifetimes. I'm 25, right? For 2 of my lifetimes, I don't think they've changed a damn thing. So companies like that are like Wrigley's, they chew gum. They don't have to change how they chew. They don't have to change how you chew gum. But with chips, you have to always innovate, make new chips. You have to make the newest chip. As soon as you fall back on that and another company comes up with a chip that's better than your chip because their R&D did better than yours this year, it's a wrap. You're taking off that throne with a quickness, and the other company, it'll reflect on their share price, and your throne being taken away is going to reflect on your share price, meaning that their stock is going to fall while the other stock that just had better R&D that took over your chip, theirs going to exceed. Like for example, if Nvidia has their chips, right? Blackwell, whatever it's called, and then AMD just came out with a chip that's better than theirs and they overtook the market, what do you think is going to happen to Nvidia stock? Right? So moving forward, SGA expenses divided by gross profit. So SGA expenses divided by gross profit. Again, we're looking for 30%, right? Ideally, as close to 30 as possible. So we'll find out right now. 30% gross profit. We're going to put selling, right? Here we are. Selling, general, administrative expenses total. So, I'm not even gonna lie to you, man. It's not looking good. It's not look. I mean, we'll find out. 213, 96. There we go. Divided by 457.09. 46%. Not terrible, right? Not terrible. Not terrible. It wasn't 30%, but it's definitely not nowhere near 80%, right? So They cooking. I'm not even gonna lie to you. They're cooking right now. They're cooking. I like it so far. So far, I like it. Got a Bing. This is a bit complicated. Interest expense divided by operating profit. Right. So this is what they pay in interest from their operating profit. So an example of this would be like a deli, right? You have a deli, you take out a loan, right? Now you got that loan money, but you got to pay off the loan. So the deli is producing income, right? Obviously, they have their cash flow. Out of the money that the deli brings in, how much of that money do you use to pay off that loan you just took? That's what interest expense divided by operating profit is. So I obviously this company has properties, right? So they have an interest on certain loans that they have to pay. And that's disregarding any loans that they took out for whatever cash purposes that they needed it for. So right now, interest expense divided by operating profit. Again, we're still on the income statement. Hold on, let me just reply to this real quick. It's okay. This is gonna go to YouTube either way. It's the stepping stones, right? Start of it all. Because in the future, you can utilize this information. So, interest expense, operating profit. So, operating profit is operating income, right? So, this company is not disappointing. I'm not even gonna lie to you. So, 50 million, right? Divided by 242 million. 20%. It's not a bad number. So they out of their operating profit, they utilize 20% of their operating profit to pay off interest. That's sustainable. I like that. I like that a lot. I like that a lot. That's sustainable. I like that a lot. Right? So, in any given industry, the company with the lowest ratio of interest payments to operating income is usually the company most likely to have competitive advantage. You can do a quality check, right? So sometimes companies like to tell the world that they are making more money than they actually are. One of the ways to see if they are telling the truth is to look into the documents they file with the SEC. We talked about this already, and see what they are paying in income taxes. Hear me out. Take that number, they list it as pre-tax operating income and deduct 35% from it. 35% is the average tax rate from its operating income in corporations. So we're going to do pre-tax. All right. So you just got to write pre-tax income. So you could take 193 million. All right. We're going to go to our percentage calculator. Right. So 35% of 193 million. And what was it? 193 million 11. It is 67 million. So they got 67 million, right? 67 million. They said it was 50 million. So there's about 17 million that's unaccounted for. It's all right. Not tripping. They're steady. I like it so far. Let's see what happens. Because we're not finished, right? So that's not important. So we're on balance sheet now. We're on balance sheet now. But I want to take this moment because since we're done with the income statement, I want to take this moment to show you guys with the balance sheet, there's a whole lot more, as you can tell right here. There's a whole lot more you need to account for. Balance sheet is kind of important. And the cash flow statement, this is about 3. And then there's some bonus metrics. The weighted average cost of capital, what it means, and then the return on invested capital, right? So we're going to get to those and we're going to go through the balance sheet right now, right? So net income divided by shares outstanding, per share earnings, we already know that it's about $6. Company with consistent earnings that show a long-term upward trend illustrates an excellent sign that the company in question has some kind of long-term competitive advantage working in its favor. Now I'm gonna leave this right here on balance sheet and cash, and I just want to say something. So far, BYD has shown promise when it comes to the income statement. We're going to go through the balance sheet and then the cash flow to confirm that it does operate with a competitive advantage and that it has good long-term growth ahead of it. So, for YouTube, if you like what you've seen so far, like, comment, share it with somebody that wants to get started in investing, because this PDF is free. All you have to do is just join the school community. It's the first message when you sign up and you join. You could take this, study it, use it. Again, it's 100% free, no strings attached. Just all I ask for is that you share what your experiences are using the PDF that I constructed for fundamental evaluations, right? So, like I said before, like, comment, share with somebody that wants to get started in investing, and subscribe for more content like this. If you want to see the breakdown in full, all you have to do is just tune in every Saturday. And I change the hours once in a while, but it's usually every time around like 12 to 3 o'clock is when I would start. But excuse me. Um, this is to basically help others invest and help others evaluate companies, because I don't just do the invest, like I trade options, I trade futures, right? But I only like to trade companies that I think have competitive advantages and that I would own outright for 5 to 10 years, right? So I take pride in knowing that a company I'm trading with actually has solid fundamentals, because with the option contracts that I do, I would normally do them for about a couple months to a year out, right? So I want to make sure that my money's good for a year out. If I know that the company's fundamentally sound, then I don't have any problem putting my money there, knowing, especially if the economy's in a good place and I know that the company's going to continue to perform. So if you like what you see and you're interested in learning how to invest and learning how to pick winners from losers in the stock market, then feel free. I will leave a link in the description and to join the school community. And I'll also put in a trading vocabulary so you understand the lingo when it comes to investing and trading. So this is MFR. It's my pleasure to help you guys because again, this is me. I would have done this either way for BYD. I would have done this either way for Apple. I would have done this either way for Nvidia. I would have done this. I take time out of my day and I actually look these companies up and I study their finances and I do that, right? So all I'm doing is just sharing what I do with y'all. So because I know I'm gonna do it either way, I'm like, all right, I'm gonna just put it. People can join, and then boom, they'll learn along with me because the stock market is ever changing. But the idea is to have others, is to inform others, to help others to grow, to help them understand that there is a way out. You don't have to be stuck where you are if you know you can do more than just rely on your 401k and your 9 to 5. You can set up your own portfolio, your own Roth IRA, and you can outperform the market year on year and use leveraged stock, which is options contracts, to get more profit from the companies you were already invested in. So that being said, I'm done with my rant. MFR out of here. Good luck to you guys and follow for more. Subscribe for more. Do all that. Hit the like, comment, everything. And like I said, it's free. But I'm gonna see you out there. We're gonna go and move on to the balance sheet. So cash is king. I'm gonna write that here. Balance sheet.